In this video, we'll discuss the second chapter from Business Finance Essentials, Financial Statement Analysis. After completing this chapter, you should be able to discuss the purpose and key issues associated with the income statement, balance sheet, and statement of cash flows, identify three components of statement of cash flows and interpret each of them, calculate and interpret key financial ratios as well as common size income statements and balance sheets, discuss and apply the concepts of trend and comparative analysis, including both their strengths and weaknesses, identify key users of financial statement analysis, identify potential strengths and weaknesses for a firm, given firm financial statements and industry or competitor, and then discuss and interpret the many issues associated with financial statement analysis, like seasonality, context, etc. There are three key financial statements that are important to investors: security analysts, management, and creditors. These are the income statement, balance sheet, and statement of cash flows. There is a fourth financial statement called the Statement of Retained Earnings that's provided in these reports. The other three capture the majority of the information needed for financial statement analysis, and that's where we'll focus. Note that this particular book has sample financial statements available in the Appendix B for Walmart and Target. These financial statements were compiled from Yahoo Finance, which attempts to fit financial statements to a mostly common template. In practice, financial analysts will use financial statements provided directly from the company as part of the firm's 10Q and 10K reports required by the SEC. These official statements provide many additional details and notes that are not available from places that provide general financial information, but are essential to provide the context to make maximum use of the financial statements. The income statement provides information on the company's revenues and expenses over a specific time period, usually annually or quarterly. These revenues and expenses are accounting-based and are not necessarily reflective of cash flows generated. For example, when a long-term asset is purchased, the cash is spent at that time. However, its expenses are recognized over time as depreciation instead of at the point of purchase. Also, the method chosen to account for inventory can cause discrepancies between net income and cash flow from operations. The cost for inventory is recognized when it's sold, not when it's paid for. While the income statement is not cash-based, that doesn't imply that it's meaningless. It still provides a good picture of how well the company is doing, but we must recognize that net income is not cash. The balance sheet provides a snapshot of the company's assets, liabilities, and owner's equity at a specific point in time. The company's assets must be financed by either debt or ownership interest. Assets will always equal liabilities plus owner's equity. Note that the values reported on the balance sheet are book values and don't necessarily represent the market value of the asset or ownership interest for a variety of reasons. The value of brand names, patents, and other intellectual property, which are often quite valuable to a corporation, are not typically recorded on the balance sheet. The book value of assets is based on historical costs less accumulated depreciation. The real or market value of the assets is based on the ability of the firm to generate cash flows from those assets. The market value of a firm may incorporate value from assets not actually on the balance sheet, but are anticipated to enhance the firm's ability to generate cash flows in the future. An example of this would be Tesla, which would likely lose significant market value if Elon Musk was not associated with the company. Typically, investors are willing to pay more for the firm than the balance sheet tells us it's worth, because the balance sheet tends to be a conservative estimate of the true value of the firm's assets, although sometimes the balance sheet will overstate the market value of the firm's shares. Also remember that the balance sheet represents a point in time and may not be the same throughout the year. For example, a company like Walmart may have relatively high inventory and low cash at the end of the third quarter, which is the start of the Christmas shopping season, and relatively low inventory at the end of the fourth quarter, which is the end of the Christmas shopping season. The statement of cash flows attempts to reconcile the differences between net income according to GAAP and cash flows. Cash flows are broken down in three primary areas: operations, investments, and financing. Cash flow from operating activities is the most critical component of the statement of cash flows. It provides insight into how well the firm is doing at generating cash flows from its day-to-day operations before factoring in any capital investments or financing issues. This is done by starting with net income and then adjusting back to a cash-based version of income. For example, depreciation lowers net income, but is not a cash expense. Therefore, depreciation is added back in. If our accounts receivable declines, that means we've collected additional cash from sales. Remember from accounting that revenue is recorded when the sale is made, not when the cash is collected. Therefore, a decline in accounts receivable indicates that our cash flow this period is higher than indicated by our net income. Ideally, we want to see this be positive and growing over time. The idea is that if a firm is going to survive as a going concern, it needs to be able to generate positive cash flows from its basic business operations. In addition, investors like to see companies grow over time. As we will see, the faster a company grows, all else equal, the more valuable it will be. Sometimes one or both of these conditions are not met. If so, it is incumbent on the analyst or management to understand why not and how it can be addressed. Operating cash flows can be negative due to short-term operating problems that are being addressed, due to economic or industry issues, or due to more significant operating problems. The impact on the firm will vary depending on how likely the negative operating cash flows are to be a short-term versus a long-term issue. Growth, while less important, is also something that analysts or management want to address if it is stagnant or declining. Cash flow from investing activities. Again, it is important for firms to operate as a going concern, which means that they need to invest in their business. This may be updating long-term assets that are getting worn out, spending money on new equipment to improve productivity, or spending money on expanding the business. These investments into long-term assets are commonly referred to as capital expenditures and are essential to a firm remaining competitive and successful. They are also a key element in the cash flow from investing activities segment of the statement of cash flows as they represent investment into the company. Because the firm is spending money on these investments, they will typically be negative or cash outflows. While we want cash flows overall to be positive, negative cash flows from investing activities are not a concern and instead are an essential part of a firm's long-term success. The reason for concern would be if a firm is underinvesting in its long-term assets or if it is spending too much on unproductive assets. These both can be difficult to identify in the short run, as there is often a lag between when investments are made and when the payoffs show up in the cash flow from operating activities section. Turning to cash flow for financing activities, if a firm generates more cash flow from its operating activities than it spends on investing activities, it will have cash left over to return to investors or add to cash balances. Alternatively, if a firm spends more cash flow on its investment activities than it generates from operating activities, it will need to raise additional cash from investors or draw down cash balances. This is an area that can be as much about whether or not a firm is in its growth cycle as it is about the firm's health. Typically, younger firms and rapidly growing firms need to spend a lot of cash on expanding the business and may not have enough operating cash flows to fund those investing activities. As such, it is common for them to be raising capital by issuing shares of stock or issuing debt, and they are unlikely to be using much, if any, cash to pay dividends. This leads to positive cash flows from financing activities. Alternatively, more mature companies are likely to be generating more than enough cash from their operating activities to meet their investment demands. Therefore, they will have cash to pay dividends, buy back outstanding shares of stock, or pay back existing debt. This leads to negative cash flows from financing activities. All else equal, negative cash flows from financing activities are a better sign of a company's health than positive cash flows from financing activities. However, an analyst needs to consider whether the firm is in its growth cycle before jumping to conclusions. You can see examples of Garmin's financial statements within the 2016 Garmin Annual Report. These are provided in the text. They also provide a slideshow where they discuss their second quarter results with investors in 2017. Financial statements provide a wealth of information to many different users. There are many ways to analyze financial statements. These include ratio analysis and common size statements, both of which can be analyzed through trend analysis or comparative analysis. While ratio analysis and common size statements provide an excellent way to analyze the information in the income statement and balance sheet, the statement of cash flows is best analyzed by breaking it down into its three primary components: There are a large variety of different financial ratios that attempt to evaluate different aspects of a company's health performance. Some of these are specific to certain industries. For example, a popular ratio for brick and mortar retailers is sales per square foot, as it addresses how well the retailer is using its floor space to generate revenue. However, the same ratio would not make sense in evaluating the performance of a heavy equipment manufacturer like Caterpillar. Another challenge with ratios is that they can be calculated in different ways. For example, the inventory turnover ratio is sometimes calculated as sales over inventory, and sometimes as cost of goods sold over inventory. To make things more complicated, sometimes the inventory level used as the denominator is defined as the beginning inventory plus ending inventory over 2, and other times analysts will simply use ending inventory. Some ratios also go by different names. The quick ratio is sometimes referred to as the acid test ratio, or the day sales outstanding ratio is sometimes referred to as the average collection ratio. This can make ratio analysis quite confusing for people who are just getting introduced to the topic. For this class, we're going to focus on the following ratios, which will be referred to and calculated as follows, using ending values for balance sheet items. Liquidity ratios are designed to measure a firm's ability to meet short-term liability, accounts payable, accruables, short-term loans, etc., obligations. If these ratios are too low, that could mean that a company does not have the ability to repay its current liabilities as they become due and would be a sign of financial distress. Some firms will intentionally keep these ratios low as an aggressive strategy. Since short-term liabilities are typically a cheap form of financing and current assets typically offer low rates of return, firms that are confident that they can refinance short-term liabilities as they become due or generate enough cash flows to cover those short-term liabilities may try to maintain low liquidity ratios to maximize returns. However, this can be a risky strategy. On the other hand, if these ratios are too high, it may indicate that a company is not doing enough to maximize returns, as they are focusing too much on current assets and not enough on developing new products or markets. The current ratio measures the ratio of a firm's current assets to its current liabilities. As a simple rule of thumb, most people like to see the ratio be between 1.5 and 4. However, industry and strategy differences may result in occasional higher or lower values that are also considered okay. The quick ratio, or acid test ratio, removes inventory from the current asset mix because it is the least liquid current asset. Before it can become cash to pay off liabilities, it must first be sold and, if it is sold on a receivable basis, the sale be paid for in cash. As a simple rule of thumb, most people like to see this ratio between 1 and 2. As with the current ratio, some firms may be above or below this due to industry norms or strategic decisions and still be okay. Asset management ratios are designed to see how well a company is doing at generating sales from the current and long-term assets. The day sales outstanding ratio is a little different from the other ratios in this category in that it is measuring collection time for our accounts receivable instead of our ability to generate sales from accounts receivable. Inventory turnover. The more frequently we can turn over our inventory, the better off we'll be. Holding inventory is expensive in terms of storage, obsolescence, and financing cost. A higher inventory turnover means more inventory moving through our firm and less sitting on the shelves. This ratio is very industry dependent, so determining what is good or bad will depend a lot on the industry. In general, the higher the better. However, we should not necessarily try to maximize the inventory turnover ratio, as that may mean stock outages or not enough variety of merchandise and lower our overall revenues. Day sales outstanding. The quicker we can collect our receivables, the better off we'll be. High values for the DSO ratio, sometimes referred to as the average collection period, indicate that it's taking us longer to collect our sales. This likely means higher financing costs and/or more bad debt expenses. It also may be a sign that we have to offer our customers more favorable financing terms in order to maintain sales. Sometimes this is referred to as stuffing the channel, as our customers may be encouraged to buy ahead due to the favorable financing terms and will not need to buy as much from us next month or quarter. While a high level of DSO is likely a bad sign, it is not necessarily true that we want the ratio to be as low as possible. Allowing our customers to use credit is likely to help increase our sales, and in turn, our profits or cash flows. If our DSO is too low, we may be losing sales opportunities. A sudden increase from last year or being notably higher than our competitors is likely to be a red flag, unless there's a reasonable explanation. Fixed asset turnover. Fixed assets typically refer to long-term assets like property, plant, and equipment. The greater the fixed asset turnover ratio, the better the job we're doing of generating high sales with limited capital investment. As with many ratios, this will be very dependent on industry, as some industries are much more capital intensive than others. Total asset turnover. Total assets include both long-term and short-term assets. Just like the FAT ratio, higher is generally better, as it indicates that we are generating high levels of sales on our investment in assets. Debt management ratios are designed to see how well a company is doing at servicing their long-term debt obligations. Total debt to total assets. The higher the level, the more risk the company is taking in their financing mix. This is not necessarily good or bad. There are some advantages to using debt financing, but it also increases the risk. Some companies can afford higher levels without increasing the risk too much, while other firms need to keep this ratio lower. Management philosophy, firm size, profitability, and industry will play a large part in determining what an acceptable level is. However, if this number is increasing dramatically or much higher than the industry average, there's reason to be concerned. Total debt to total equity. This ratio is similar to the previous ratio. Note that assets equal liabilities plus owner's equity. The primary difference here is that this will almost always be less than 1, while the previous ratio be greater than 1, or this current ratio be greater than 1. Again, a higher value is neither good or bad, but indicative of greater risk. Times interest earned. The tie ratio looks at how easily we're able to meet our interest requirements. Since we could be forced into bankruptcy if we can't pay our interest payments, this is important. Companies can typically meet interest obligations for a short time when the tie is less than 1 or negative by reducing their assets, but this is only a short-term solution. In general, we'd like to see tie above 2 in order to provide a little cushion. Another concern is that tie ratio may provide a false sense of comfort if we are starting a downturn, because we're more concerned with the ability to make future interest payments rather than past, and a downturn may cause our EBIT to fall much faster than our interest. Profitability ratios analyze how well we are doing at generating profits for our shareholders. There are multiple ratios here, as there are different ways to identify profits in different bases, like sales, assets, or owner's equity, that may be relevant. Gross profit margin. The higher it is, the greater markup we're able to have on our inventory. Looking at this ratio over time or compared to key competitors is a good way to evaluate our inventory costs and, in some cases, the ability of our brand to extract higher value. Net profit margin. The higher this is, the more of each sales dollar is making it to the bottom line. A company with a high profit margin will generate much more for its shareholders than a company with a low profit margin at the same level of sales. Profit margins are typically sensitive to economic conditions and also vary substantially from industry to industry. Return on assets. The higher the ROA, the better. We want to generate as much profit from each dollar invested in assets as possible. Typically, ROA, like profit margin, will be sensitive to economic conditions and vary substantially from industry to industry. The more asset intensive the industry, the lower the ROA. Return on equity. The equity represents the shareholder's contribution to the firm. Therefore, the ROE looks at how much profit we're making for each dollar invested by shareholders. The higher the ROE, the better. Companies can increase their ROE by using more debt financing. However, as mentioned earlier, this increases the risk level. ROE, assuming it's positive, should always be higher than ROA. Market value ratios are the most difficult to interpret. They measure how cheap or expensive the stock is relative to accounting measures. However, there are a large number of reasons why a stock should be more or less expensive than another relative to a specific accounting measure. While there are too many issues to discuss related to these ratios to explain them all, we'll offer a sample issue with each ratio. The PE ratio measures how much you are paying for each dollar that the firm makes on a per-share basis. While a lower PE ratio is cheaper, consider a company's growth rate. If company A is growing rapidly and company B is not growing at all, you should expect to pay more for a dollar in earnings from company A than for the same dollar of earnings from company B. Finance is forward-looking, and company A should make much more per share going forward than company B. There are many other reasons why PE ratios vary from firm to firm, and by itself, the PE ratio is not a very good indicator of whether a stock is too cheap or too expensive. However, it is much better than just looking at the stock price by itself. For instance, on August 11, 2017, Alphabet, or Google stock, had a price of $930.09, while Facebook, FB, had a price of $168.08. Note Facebook is now Meta. At first glance, it seems like Alphabet is about 5 times expensive as Meta. However, Alphabet earned $29.59 per share, while Meta earned $3.93 per share over the previous 12 months. Thus, Alphabet is actually cheaper in terms of earning power per share relative to what you pay for the share, than Meta, as Alphabet has a PE of 31.43 and versus Meta's PE of 42.74. A simple way to think of these PE ratios is that it costs $31.43 to buy $1 of earnings if you buy Alphabet, while it costs $42.74 to buy $1 of earnings if you buy Meta. Why are investors paying 25 to 30% more for each dollar earned by Meta? The answer is likely in perceived expected growth, although there may be other factors. Typically, the higher the expected growth, the more expensive or higher PE the stock. Investors are expecting higher growth rates for Meta than Alphabet over the remaining life of the two companies. Other possibilities may include risk. Higher risk tends to lead to lower PE ratios. Quality of earnings, higher quality of earnings should lead to higher PE ratios, and several other factors. The market to book ratio measures how expensive the stock is relative to its accounting value. The higher the ratio, the more expensive a stock is. Typically the ratio will be high due to intangible assets such as brand names not being fully recognized by the balance sheet, or high future growth rates not recognized by the historical value of assets, or investors being over optimistic about the future. Because of the latter, there's a tendency for low market value to book value stocks to be better investments, higher risk adjusted rates of return on average over long periods than high market value to book value stocks. Looking again at Alphabet and Meta, the book value per share as of August 11, 2017 for Alphabet is $209.43, while Meta had a book value per share of $21.50. Given the price of each stock, $19.30.09 for Alphabet and $168.08 for Meta, it gives Alphabet a market value to book value ratio of 4.44 and Meta had a ratio of 7.82. Alphabet is cheaper than Facebook in terms of the ratio despite its higher price tag. In both cases, Alphabet being cheaper does not make it a better investment. It depends on whether or not Meta is worth a higher valuation. Dividend yield. Many conservative investors look for stocks that pay dividends as a source of current income and safety. Since firms are reluctant to cut dividends and tend to only do so in times of severe financial distress, dividends provide a little bit of market protection for stock prices. If the stock price starts to fall too much, the current income potential of dividend attracts buyers, and are more predictable than capital gains, although capital gains can be quite a bit higher. Dividend yields will vary significantly with many companies not paying dividends, and some companies paying dividends as high as 5 to 6%, or occasionally even higher. Typically, firms that pay dividends are ones that have entered the cash cow stage of their life cycle, where they are generating more cash flows than they can reasonably invest. Younger, faster growing firms are less likely to pay dividends and reinvest it into the firm. Some companies will use their extra cash flow to buy back shares instead of paying dividends, which theoretically should cause the stock price to rise slightly by reducing the shares outstanding. The pie is cut into fewer pieces. There are a couple of reminders to note. First, EPS refers to earnings per share and is simply, for the purposes here, net income divided by number of shares outstanding. Second, sales and revenues are used interchangeably. Therefore, you can replace sales with revenues in any formula. The goal here is not to make you an expert on ratio analysis, but to introduce it as a tool. This list of ratios provides a strong foundation to build from if you delve further into ratio analysis. One item of note to stress is that interpreting ratios is as much of an art form as a science, as there are always exceptions. Often, textbooks imply that once you calculate the ratios, you can easily identify a firm's strengths and/or weaknesses and take advantage of them and/or fix them. This is an illusion. Calculating the ratios is relatively simple. Interpreting the ratios requires context, understanding, and experience. You need to understand where the numbers are coming from and why they are what they are. For instance, corporate strategy, company downturn, economic downturn, seasonality, etc., in order to really make meaningful analysis. Explanation of ratios in the Appendix B focuses on explaining and interpreting each of these ratios. However, even if you can adequately interpret the ratios, they are diagnostic more than prescriptive. We will discuss some of the challenges in applying ratio and other forms of financial statement analysis next. In addition to ratios, we can also glean information from financial statements by comparing them from year to year or from firm to firm. However, we need to be careful. If sales go up year to year, most likely so will costs. What becomes important then is not did costs go up, but how did they change relative to sales? Alternatively, Our inventory may be down, but if all of our other assets are down as well, we may be starting to carry too much inventory. Our selling and administrative expenses, or accounts receivable, may appear relatively low to our competitors. However, if their firm is 3 times the size of ours, these expenses or receivables may still be too high. To fix these problems, we can develop common-size income statements and common-size balance sheets. A common-size income statement takes each category in the income statement and divides by sales, expressing the item as a percentage of sales. A common-size balance sheet divides each component of the balance sheet by total assets, expressing each item as a percentage of assets. This makes it easier to compare items from year to year or across different size firms and see how well the company is doing in each component. The ratios presented are close to meaningless by themselves. Looking at a single ratio in isolation is about as useful as a physician trying to perform a diagnosis simply by looking at your temperature. It is a piece of the puzzle, but without context and additional information, it is not very meaningful. Also, common size statements offer little value without context. In order for them to become valuable for analysis, we must have something to compare them to. One technique is to view how these ratios and common size statements change over time. For example, is our ROA rising or falling from year to year? If it is rising, that indicates we're doing a better job of generating profits from our assets. Alternatively, if our DSO ratio is rising, that indicates it is taking us longer to collect our credit sales. This may be a sign of a problem. Note that we say may because it is also possible that we are intentionally offering more or better credit opportunities to customers in order to increase sales because our DSO was lower than optimal before. While we can do trend analysis for 2 years, it's better to have 3 to 5 years of ratios to analyze to truly spot trends. Too few years makes it hard to identify real trends as opposed to just normal year-to-year fluctuations. Alternatively, too many years may present a misleading picture as the company, industry, and economy has likely changed too much over the period to make comparisons meaningful. If you use quarterly data for trend analysis, be careful of seasonality. It may not be appropriate to compare quarter 2 to quarter 1, but instead only to quarter 2 of last year. Potential problems with trend analysis. One challenge with financial statement analysis is that many of the techniques we use help provide context for analysis, but they typically also have some flaws. Trend analysis is no different. Seasonality. Due to seasonality in quarterly financial statements and annual balance sheets, seasonality concerns may lead to distortions in trends. We must be aware of how seasonality can impact our ratios and common size statements before we can properly analyze trends. Trend changes. Trend analysis is designed to help us identify weaknesses and forecast future performance. The problem is trends can change suddenly. Often we cannot identify changes in trends until after they have happened, which can hinder our ability to use trends for predictions. Fundamental changes. Significant changes in firm strategy or industry dynamics may make comparisons to previous years less meaningful. Another way to make the ratios and common size statements meaningful is to compare them to industry averages or key competitors. For example, labor-intensive industries may have high return on asset numbers, while companies in capital asset-intensive industries may have relatively low return on assets. Also, grocery stores are likely to have higher cost of goods sold values as a percentage of sales than software developers. If you're analyzing a software developer, it is important to compare it to others in the industry to determine if the numbers are good or bad. If our numbers compare favorably to the industry average, that is a good sign, and numbers that compare unfavorably to the industry average indicate potential weaknesses. However, we must be careful here. Our goal is not to be average. If we are better than the industry average in an area, that does not mean we have no room for improvement, and management should ignore that area. Potential problems with comparative analysis. Just like trend analysis, comparative analysis provides insights but also introduces some challenges. Some of these challenges are listed below. Conglomerates. Some companies, such as Compass Minerals or Amazon.com, defy industry classification. Compass Minerals is both active in salt mining and plant nutrition, which are two very different business lines. Amazon.com is a major retailer. However, they also offer streaming services, cloud computing, and are active in voice-related artificial intelligence. When a firm is involved in many different industries, comparative analysis can be misleading or extremely difficult to implement. Concentrated industry. Some companies, such as Meta, dominate an industry to such a large extent that it can be misleading to compare them to the industry norm. It may also be hard to find a sample of direct, publicly traded competitors to put together a good comparison. Who uses financial statement analysis? The answer is many different groups of individuals and institutions who are concerned when identifying the health and performance of a company. This includes, but is not limited to, the following groups. Managers need to evaluate a variety of ratios in order to properly manage their firm. They need to understand the liquidity situation, how well the company is doing at generating sales from their assets, what the debt picture is telling them, how profitable they are, and how investors are valuing their stock. As such, they need the big picture view provided by all the ratios, an evaluation of statement of cash flows, and common size statements. Competitors. Like management of our own company, management of our competitors are going to need a big picture overview of our firm, as well as their other competitors, to evaluate their own strengths and weaknesses relative to their competition. Long-term lenders. While current and potential bondholders and other long-term lenders are going to evaluate many areas covered by financial statement analysis, there are certain areas that are more important and others that are less critical. For example, a current or potential bondholder is not likely to care much about the firm's PE ratio or inventory turnover ratio. On the other hand, debt management and liquidity ratios are going to be a big focus. Profitability ratios are somewhat in the middle. While long-term lenders prefer firms be profitable enough to have a margin of error in generating enough cash flows to meet their interest obligations and repay the principal, they are not really concerned with seeing profitability ratios be on the high end of the industry, as they don't benefit from excess profits like stockholders do. Short-term creditors. Like long-term lenders, short-term creditors are focused on the firm's ability to repay its liabilities. However, they are less concerned with debt management ratios and more concerned with liquidity ratios. Whether the firm can meet their long-term obligations is less relevant, as long as the firm can generate enough cash flows to meet their current obligations. Stock investors are going to have more of a big picture focus than creditors. This is because the firm has to be generating sufficient cash flows, have significant and reliable profitability, meet its debt obligations as stockholders come after bondholders and the priority of claims, and be able to purchase shares at a reasonable price. One of the big challenges in financial statement analysis is that there are many factors that don't follow the rules, and there are exceptions to everything. For example, a common rule of thumb for the liquidity ratios is that we want to see the current ratio at 2 or higher, and the quicker asset test ratio at 1 or higher. If these numbers are too low, it could be a sign that the firm is suffering liquidity issues and may have problems meeting its current liability obligations. Consider Walmart. As of the January 31st, 2017 annual balance sheet, Walmart had a current ratio of 0.86 and a quick ratio of 0.22. Note that you can see this table from Walmart and Target in the Appendix B. At first glance, it would appear that Walmart's on the verge of bankruptcy as they will not be able to pay their current liabilities. However, does anyone really believe Walmart's in a financial crisis? Many do not believe so. Instead, they know their inventory will turn over quickly, and they have access to capital, so they don't need to hold much in current assets beyond their inventory. This is a strategy that allows them to earn higher rates of return. Another firm with slower inventory turnover, less favorable relationships with suppliers, or less access to capital may be in severe problems with the same or even slightly higher ratios. Also consider that when liquidity ratios are too high, that can be considered a problem, as it indicates firms are being inefficient in allocating their resources. Long-term assets generally offer higher returns than current assets. However, Meta has a current and quick, since they don't have any inventory listed, ratio of nearly 12 at the end of their 2016 fiscal year. Does that imply that Meta is not smart enough to properly allocate their capital? Or might there be other explanations for their high liquidity ratios? The key here is that it can be harder than it may seem to identify good or bad levels of ratios. Another problem is identifying what a significant change is. For example, let's say that our ROE is 14.3% and the industry average is 14.5%. We are below the industry average, but only by a very small amount. Obviously, we'd like it to be higher, but is this a weak spot or is it an average spot? How much below the industry average do we need to be before we get concerned? Let's say that last year our ROE was 14% and industry average last year was still 14.5%. Now we have increased our ROE marginally, but it's still slightly below the industry average. Is it a strength because it's improving, a weakness because it's below the industry average, or neutral because there was little change and we're close to the average? Again, how much different do the numbers need to be before we're concerned? These are judgment calls without clear answers. Another issue is that while financial statement analysis might help us identify potential strengths and weaknesses, it doesn't tell us what to do about them. For example, let's say our net profit margin is rising and significantly higher than the industry average. This is good, but how does it help management? Can they ignore it and focus their attention elsewhere? If so, will it stay a strength? From an investor's perspective, does this make us want to buy the stock? Maybe it's a plus, but what if the stock price is high enough that it already captures this strength, or is overvalued because of this? Ratio analysis should not be confused with stock valuation or an investment decision-making tool, but instead a piece of the puzzle. Alternatively, what if our inventory turnover is significantly below the industry average and declining? We may know we have a problem, but we still have to figure out how to fix it. From an investor's perspective, is this a reason to avoid the stock, or is it offset by other strengths? Again, ratios will not tell us by themselves whether or not a stock is a good or poor investment. Another item to remember is that when we go through our financial statement analysis, we are typically not identifying problems or strengths, but potential problems or strengths. Think of the process as flagging areas for further investigation. When you visit a doctor, she checks your vital stats and asks you about symptoms. This is where the doctor generates an initial diagnosis, but then usually a series of tests are done to confirm what is wrong. Financial statement analysis is the initial diagnosis stage. Once you identify areas of concern, then you need to dig deeper to see what is going on and why. Once you have this additional information, then you can decide if it needs fixed, and if so, how to proceed. In financial analysis, statement analysis, context is everything. We cannot look at a single ratio in isolation. A company may have a great inventory turnover ratio, but not be doing so profitably or be having problems meeting their debt obligations. A firm may be seeing profitability rise, but slower than the industry average. A company may have abnormally high or low ratios, or items in common size statements, relative to the industry, but be pursuing a different strategy than the industry. For example, one firm may have a higher inventory turnover with lower profit margin, while another may have a lower inventory turnover with a higher profit margin. Both strategies may be successful and allow the firms to differentiate their target market. It does not mean one firm needs to increase their profit margin and the other needs to improve their inventory turnover. Because of the importance of context and other issues raised above, financial statement analysis is a useful but very challenging tool to apply. The income statement, balance sheet, and statement of cash flows provide significant information which management and analysts can use to diagnose potential strengths and weaknesses of the firm. While the statement of cash flows provides significant information in its original format, the data from the income statement and balance sheet can provide additional insights through the use of financial ratios and common size statements. Despite the ability of financial statement analysis to provide insights into the firm's performance, it can be challenging to get the full benefits from this tool in a finance professional's kit. The reason for this challenge is that context is essential to interpreting the results of such analysis, and that even with the appropriate context, it can be difficult to correctly diagnose opportunities and problems. Context can be provided by trend and comparative analysis, along with understanding the dynamics of the firm and its environment. We now turn to some exercises. The income statement captures all activity-related revenues and expenses over a particular time period. For instance, the quarterly income statement includes all revenue and expense items for that quarter. The beginning of the quarter is treated the same as the end of the quarter. The same applies for annual income statements. However, balance sheets represent a firm's assets, liabilities, and owner's equity at a particular point in time. The quarterly balance sheet only reflects the last day of that quarter, and the annual balance sheet only reflects the last day of the year. As such, the balance sheet is more open to seasonality issues and short-term fluctuations. For instance, if the balance sheet is prepared one day prior to a large cash payment, the cash account will appear artificially large. On the other hand, if it is prepared one day after the payment, the cash account will appear artificially small. The firm has $60 million in total liabilities. 100 equals L plus 40, minus 40 from both sides yields L equals 60, because assets equals liabilities plus owner's equity. Depreciation is a non-cash expense. While it lowers net income, the firm is not actually paying anything for depreciation, so it has no impact on cash flows. Ignoring taxes, when considering taxes, Depreciation lowers net income, it increases cash flows as less cash is paid in taxes. The cash flow impact of an asset purchase from a finance perspective occurs when the asset is purchased. Spreading the costs equally over the asset's useful life ignores the time value of money and understates the true cost of the purchase. A few other issues that may create a difference between cash flows and earnings include revenue recognition, inventory accounting method, prepaid expenses, accounts payable, accounts receivable, among others. While many people use ratio analysis, the primary parties interested are management, competitors, stockholders and potential stockholders, long-term creditors, short-term creditors. When analyzing liquidity ratios, the most interested parties are management and short-term creditors. Management needs to understand the firm's liquidity position in order to properly manage the firm. Short-term creditors typically don't care much about the long-term health of the firm, but only if they have enough liquid capital to meet the short-term obligations. Long-term creditors and stockholders would also be interested, primarily only if the liquidity ratios were weak enough to damage the long-term health of the firm. When analyzing asset management ratios, the most interested parties are management, competitors, and stockholders. Again, management must be interested in all the ratios, as they must manage all aspects of the firm's operations. Competitors are interested as a gauge of their own performance. If our competition has a total asset turnover of 2.5 and ours is only 1.95, we must understand what they are doing to outperform us in this measure. By identifying our weaknesses, we can address them. Stockholders have some interest in that often asset management ratios impact a firm's ability to generate profits and increase firm value. Long-term and short-term creditors are typically not significantly concerned with these measures, as they do not share in any extra profits the company generates. As long as the firm is able to meet interest and principal obligations, debt holders are happy. Management, long-term creditors, short-term creditors, and stockholders are all focused on debt management ratios. These ratios measure a firm's ability to meet their debt obligations. So creditors want to see these ratios strong in order to be confident of receiving their full interest and principal payments. Long-term creditors are probably more focused on this, as short-term creditors hope to be repaid quickly enough that they are more concerned about the liquidity issues. Stockholders are concerned because if the firm is unable to meet its debt obligations, it will be forced into bankruptcy, and the stockholders will likely lose all of their investment. Profitability ratios are concerned primarily for management, competitors, and stockholders. Creditors, both long-term and short-term, do not participate in profits, so their only concern with profitability ratios is if they are negative and threaten the ability of the firm to meet interest and principal payments. Like asset management ratios, competitors use profitability ratios as a method to gauge their strengths and weaknesses. Since stockholders own the business, the profits belong to them. Therefore, the stronger the profitability ratios, the happier the stockholders are. Market value ratios are looked at by stockholders and management. These ratios measure how cheap or expensive the stock is. Management typically wants these ratios to be high, as it is a sign that they are maximizing firm value. Potential stockholders typically want them as low, as that is an indication that the stock may be cheap, except for dividend yield. Note, market value ratios are often much more difficult to analyze than many people would like. The key of this question, recognizing the role of the equation assets equals liability plus owner's equity in these two ratios. Because all firms use some degree of liabilities, long-term debt, accounts payable, accruals, etc., we know that assets must be larger than owner's equity. The greater the amount of debt financing or liabilities, the greater the difference between assets and owner's equity will be. Also, since the difference between ROA and ROE is the denominator, since ROA is net income over assets while ROE is net income over owner's equity, ROE will always be higher than ROE for firms with positive net income. Finally, the greater the amount of debt, financing, or liabilities, the greater difference between ROA and ROE would be. Considering above, we can now comment on the specific ROA and ROE numbers for companies A and B. Since Company B has a lower ROA and higher ROE relative to Company A, we know that Company B is using more leverage, debt financing, than Company A. Neither approach is necessarily better or worse than the other. They're just different. Company B is using a more aggressive or riskier strategy of financing. The higher level of debt increases the risk, but also means stockholders earn a greater return on money when the company does well. However, if the company does poorly, the higher leverage or debt financing will magnify the losses, as the interest must still be paid and the losses spread over less shareholder capital. Thus, higher amounts of debt financing are riskier, but also increase the potential return. Which approach is better depends on the level of risk aversion for each shareholder. The DSO ratio does provide an indication of how long it is taking a firm to collect its credit sales. Thus, a high DSO ratio can be an indication of the problem managing a firm's accounts receivable. However, one must be very careful when jumping to conclusions. First, DSO can be very industry dependent. Second, and the issue in this question, is that DSO uses both balance sheet and income statement values to calculate the ratio. As the annual income statement is not subject to seasonality while the annual balance sheet is, there is the potential for seasonality issues to distort the ratio. Specifically, Company A has larger accounts receivable in their annual balance sheet due to the seasonal nature of their sales. This inflates their DSO ratio. Company B has had plenty of time to collect their accounts receivable. This is a prime example of why you need to consider seasonality when evaluating ratios. If we think of the inventory turnover ratio, Company A should appear to be doing better. Specifically, they will have less inventory on hand at the end of the year, as their heavy sales season is winding down and they approach seasonally lower sales. Alternatively, Company B's inventory will be high to meet their seasonally high first and second quarter sales that are right around the corner. Subject to seasonality would be the quarterly income statement, quarterly balance sheet, and annual balance sheet. Not subject to seasonality would be the annual income statement. This is false. While it is true that everything else equal, a higher profit margin is better than a lower profit margin, there is not enough information to make this a true statement. We are ignoring both trend analysis and comparative analysis, so we do not have the necessary context to evaluate the profit margin number. For instance, Company A could be in a low profit margin industry, like banking or retail, while Company B could be in a high profit margin industry, like software or pharmaceuticals. Also, profit margin is only one ratio, and to label one company as outperforming another based on a single ratio is short-sighted. We need to consider the larger picture before making such a statement. The purpose of this question is to illustrate that one ratio without context is close to meaningless. Trend analysis refers to looking at a firm's ratios over a period of 3 to 5 years to identify whether specific areas are strengthening or weakening. Comparative analysis refers to looking at a firm's ratios relative to other firms in the same industry to evaluate whether they are better or worse than industry averages. Trend or comparative analysis provides us some of the necessary context to properly interpret the ratios. Identify at least one potential problem with trend analysis and one potential problem with comparative analysis. Potential problems with trend analysis include trends can change abruptly. While it is important to identify trends, we should remember that these are past trends. Volatile business conditions can cause trends to stop or reverse unexpectedly. Some patterns are not trends. If ROA increases from year 1 to year 2, this is not a trend but a one-year change. Often it's hard to distinguish between true strengthening or weakening trends and just random noise. Past data may be irrelevant. Structural or strategic changes in firms may make comparisons to past years virtually meaningless. Potential problems with comparative analysis include finding a comparison industry. Conglomerate companies such as General Electric are often involved in several industries, making it hard to compare their ratios to an industry average. Few competitors. Some large firms such as Microsoft dominate industry to the extent that it is often hard to make comparisons to industry averages. A very low quick ratio may be cause for concern because it could indicate liquidity concerns. A low level of cash and accounts receivable relative to our current liabilities could indicate that we will have a hard time paying those current liabilities when they are due. A very high quick ratio may be cause for concern because it indicates an inefficient allocation of resources. Cash and accounts receivable are not high return assets. We would likely be better off allocating our assets to areas with higher rates of return. The primary objective of financial statement analysis from the perspective of management is to identify potential strengths and weaknesses of our firm relative to our competitors so that we can take full advantages of our strengths and work on fixing our weaknesses. There are several difficulties management might encounter in conducting a complete financial statement analysis. Some are mentioned in one of the previous questions above. Other problems include comparability of financial statements across firms in the industry due to different fiscal years and/or different accounting procedures. Also, the need to dig beyond the numbers is critical. For example, is a high ROE due to a well-run company or due to too much leverage that could cause significant problems if we hit a small rough patch? Another issue is that financial statement analysis may help us identify potential strengths and weaknesses. However, Even after confirming them by digging deeper, the financial statement analysis often does not recommend how we can fix the weakness or exploit the strength. The primary objective of financial statement analysis from the perspective of the stockholder is to identify companies to invest in, potential stockholders, or evaluate the companies the stockholder currently owns, current stockholders. Stockholders face many of the same problems discussed above with management. However, an important challenge for stockholders is that they must not only analyze the company's financial health, but also evaluate how much they are paying for it. There may be situations where buying stock in a company with poor financial health is a good opportunity. The stock price is cheap enough and there's a chance for the company to rebound. There may also be situations where selling shares of a stock in a company with strong financial health is good. The stock price is so expensive that the firm's success is already more than fully reflected in the stock price. Too often, stockholders get caught up in what they are buying and don't think enough about how much they are paying for it. Problems. Using the financial statements for Joe's Gadgets in Appendix B, find the ratios for both 2016 and 2017. These are the solutions. These are the 2016 solutions continued. These are the solutions for 2017. Each item in the income statement is expressed as a percentage of sales or revenues, and each item in the balance sheet is presented as a percentage of total assets. For this question and the previous question, here is the income statement for Joe's Gadgets. Here is the balance sheet for Joe's Gadgets. Here is the solution to the problem. To start the analysis of finding strengths and weaknesses, we start with the common size statements. The first things to notice was the increase in cost of goods sold from 40% of sales in 2015 to 55% of sales in 2017. This indicates that production costs jumped significantly and will act to lower our net income. Selling and administrative expenses dropped slightly from 20% of sales to 17.5% of sales. This is a strength, but it's not a very large change, so don't place much emphasis on it. Declines in EBIT and net income as a percentage of sales are due to the increase in cost of goods sold, so don't need to do further analysis. From the common size income statement, we focus on the increase in cost of goods sold as a significant weakness and classify the decline in S&A expenses as a small strength. Proceed to the common size balance sheet. The first things to notice are the increase in accounts receivable and inventory as a percentage of total assets. This is a concern that needs more analysis before declaring a weakness. Consider accounts receivable first. Accounts receivable could increase due to higher sales levels. If 25% of my sales are done on credit and sales increase, my accounts receivable will automatically increase as well. This could result in accounts receivable being a bigger portion of a firm's assets and would not be seen as a negative. On the other hand, accounts receivable may be increasing because fewer customers are paying the bills on time. This could lead to more bad debt expense or higher collection costs. We cannot tell which explanation is causing the increase in accounts receivable from the common size balance sheet, so make a note of it and look more at the issue as you move through the analysis. Like accounts receivable, inventory increases may or may not be a weakness. If sales increase, you'll need more inventory on hand to handle the increase in sales, which is likely to cause inventory to make up a larger portion of the firm's assets. Alternatively, if you're getting stuck with more out-of-date inventory, it would also make up a larger portion of the firm's assets until you're forced to do a write-down and take the loss. From the common size balance sheet, we can't tell which scenario is taking place, so this is also something to investigate further. Net plant, property, and equipment shows a large drop in the common size balance sheet, but that is primarily as a result of the increase in current assets caused by the jump in accounts receivable and inventory, which have already been discussed. So we won't pay much attention to the decline in net plant, property, and equipment. Notes payable shows a large jump. However, that could just be a function of financing some of the increase in current assets. So again, this is not something that would concern too much. You probably want to note it and make sure to find out the reason for the increase. That's likely not a strength or weakness. The jump in total liabilities as a percentage of total assets is something that would be concerning. Higher levels of liabilities as a percentage of total assets indicates higher risk levels. The firm has a greater chance of serious financial problems if there's a slowdown. This isn't necessarily bad, as the higher debt levels also have the chance to increase their profits if things go well. However, it's something to note with a degree of caution due to the higher risk. Finally, the drop in owner's equity is merely the flip side to the increase in total liabilities, so needs no further analysis. Next, move on to the ratio analysis. Liquidity ratios appear to be sound, as both are stable from year to year and similar to the industry averages. Turning to inventory turnover ratio, this combined with the increase in inventory on the common size balance sheet indicates a problem. If inventory increase was merely a result of increased sales, the inventory turnover ratio would hold steady or increase slightly. Instead, it has decreased slightly and is noticeably lower than the industry average. This means you're tying up more capital as inventory and probably ending up with older inventory that will need to be marked down and sold at a loss. We also notice problems with DSO. The significant jump in this ratio says that it's taking 24 days longer on average to collect each dollar in sales. Since this is also much higher than the industry average, it means one of two things. Either we have a lot of customers that are not paying on time and may end up with higher levels of bad debts, or that may have to offer more favorable credit terms to customers to keep sales from dropping. Both of these possibilities are bad, so the accounts receivable situation is a definite cause for concern. FAT and TAT both look good. FAT is up and both are higher than the industry average. This is a sign that you're doing a good job overall using assets, especially long-term assets, to generate sales. The debt management ratios are troublesome. The total debt to total asset and total debt to owner's equity ratios have increased by quite a bit and are higher than the industry averages. The tie ratio has dropped and is lower than the industry average. This means our firm is using more debt financing and has less margin for error. If we experience an off year or two, our firm is likely to run into severe financial problems and could face bankruptcy. On the other hand, if we have a couple of strong years, we will make higher returns for our shareholders due to the leverage provided by debt. This is not necessarily a strength or weakness, but is a sign of high financial risk. The profitability ratios are all showing an interesting pattern that ties back into the cost of goods sold observation from the common size income statement. Profitability, according to the profit margin, return on assets, and return on equity, is down due to the increase in cost of goods sold. All three ratios are consistent with the industry average. This may be an indication that the increase in cost of goods sold is more of an industry issue rather than firm specific. If a key input had a price increase, this is likely to impact all firms in the industry equally. For example, if grain prices jump significantly, both Kellogg's and General Mills may see a jump in their cost of goods sold and a decline in their profit margins. It does not indicate a management problem, but an industry issue. If profitability ratios decline significantly and were lower than the industry average, it would be more concerned about company-specific problems. Last, we have the market value ratios, which are difficult to interpret in this instance. The price to earnings ratio has increased significantly as the stock price fell, but earnings fell faster. It is also higher than the industry average, which indicates the stock is more expensive in terms of what investors pay for each dollar of earnings, possibly indicating that they believe the earnings drop is not permanent. The market value to book value ratio has decreased significantly, which indicates the stock is cheaper. This is because book value is less sensitive to the recent earnings decline, which lowered the stock price, making the stock cheaper relative to its book value. However, the stock is still slightly more expensive than the industry average. Dividend yield increased and is higher than the industry average, which is good, but there is a danger sign here. If earnings drop any further, we may have to cut our dividend, which would cause the yield to drop. To summarize, our financial statement analysis indicates that the firm needs to address the cost of goods sold issue, but that it is probably an industry issue instead of a company-specific problem. This does not mean we can ignore it, just that it will be more difficult to fix. The firm needs to get control of its credit policies and improve its collections process. The firm needs to get control of its inventory concerns. The firm is doing a good job at generating sales from its long-term assets. The firm has a high degree of financial risk. The firm does not appear to have any major liquidity constraints. The stock is relatively expensive relative to the industry average, and the dividend yield, while attractive, should be viewed with caution, as it may not be sustainable. You know that you need the current stock price and the book value per share in order to get the market value to book value ratio. To get current stock price, you can use the PE ratio. The PE is price over earnings per share, so price is the PE times EPS. To get earnings per share, you need net income, which you can get from the net profit margin. Net profit margin is equal to net income over sales. Net income is equal to net profit margin times sales. You have the profit margin, so you need sales. You can get sales from the TAT ratio, where TAT is equal to sales over assets. That means sales equals the TAT times assets. Sales is then 1.5 times 6 million to get 9 million. Net income is 5% of 9 million to get 450,000. Earnings per share is 450,000 divided by 600,000 shares to get 75 cents per share. Stock price is 13 times 75.75 to get 975. Solve for book value, which is owner's equity per share. ROE is net income over owner's equity, so owner's income is equal to net income over ROE. Owner's equity is 450,000 divided by 0.14, which is equal to $3,214,285.71. Book value is that same number divided by 600,000 shares to get 536 per share. The market value over book value of 9.75 slash 5.36 is 1.82. That's your market value to book value ratio. This is a tough problem. It not only tests your knowledge of ratios, but your problem solving skills. Don't worry if you don't get it at first, but hopefully once you see the solution, it makes sense. This next area is an enhanced tutorial that goes over previous slide concepts, but goes into some more concepts into more detail. One of the tools that finance professionals have at their disposal for analyzing the health and performance of corporations is financial statement analysis. This can be used by a variety of people for different purposes. Some examples are company and competitor management. They use financial statement analysis to identify the firm's or the firm competitors' strengths and weaknesses. Knowing this information can improve management's ability to make strategic decisions that improve financial performance and the value of the firm. Stock investors, both current and potential, can use financial statement analysis to evaluate the potential risk and rewards of owning the stock, make forecasts of future performance, and help them determine if the stock prices are overvalued, undervalued, or fairly valued. Short-term creditors, such as suppliers and banks, can use financial statement analysis to evaluate the ability of a firm to repay their loans before they extend credit. Bond investors, both current and potential, can use financial statements to evaluate the ability of the firm to make all the promised coupon payments and the maturity payment at the bond's maturity. This can help bond investors decide if the expected return that they anticipate earning on the bond is sufficient to compensate them for the risk. All of these parties place their emphasis on different aspects of financial statements and use different tools to develop the information that helps them with their decision process. There are three key financial statements that focus on our coverage of financial statement analysis: income statement, balance sheet, statement of cash flows. Information from these three statements from the 2016 fiscal year for Walmart and Target with data pulled from Yahoo Finance are provided. Financial statements are reported according to GAAP, the generally accepted accounting principles. The advantage of a source like Yahoo Finance is they put their reports into a standard format for easier comparison. The disadvantage is they don't contain the full statements as reported in annual reports along with the footnotes. In order to do a professional quality financial statement analysis, it is critical that you read through the annual report and/or quarterly reports, the 10K and 10Q documents, so that you know not only what numbers are reported, but the details behind those numbers. This information will not be seen in summary reports like presented in Yahoo Finance or other common repositories of financial statement information. The income statement is designed to provide information related to a company's revenues, sometimes called sales, expenses, and profits. The income statement is presented on an accrual basis. This means that revenue is recognized as they are earned and expenses are recognized as they are incurred. This is very different from a cash basis, which looks at when money is received or spent. For example, consider a company that manufactures and sells widgets. When this company purchases a large piece of equipment to manufacture their widgets, they will record the expense of the equipment spread out over its lifetime. usually several years, instead of recording it when the equipment is purchased. Now, let's assume that a customer purchases 1,000 widgets on credit and doesn't have to pay until 3 months after the purchase. The revenue is still recorded at the time of the sale, even though no money was received. Being aware of these accrual concepts and their implications is very important from a finance perspective because in finance we're focused on cash. While accrual accounting does a good job of capturing a firm's performance, it can distort timing and have an impact on valuation analysis due to the time value of money. The income statement captures a firm's performance over time. This means that all transactions during the period are treated equally regardless of when they occur within the period. For instance, if I'm preparing an annual income statement, sales made at the start of the year are no different than sales made at the end of the year. All transactions related to revenues and expenses are a part of the income statement as long as they occurred in the period. The balance sheet is designed to capture information about a firm's assets, liabilities, and equity at a point in time. Assets represent the things the firm has. These can be long-term assets like property, plant, and equipment, or current assets like cash, accounts receivable, and inventory. Liabilities represent what the firm owes and can also be long-term, such as bonds the firm has issued, or short-term, such as short-term loans, accounts payable, or accruals. Owner's equity represents what belongs to the shareholders. This is often broken down into what was originally contributed when the firm issued the shares and retained earnings, or profits that had not been paid out in dividends. Note that retained earnings are an accounting tool and do not represent cash that the company is holding. A fundamental relationship in the balance sheet is the formula assets equals liabilities plus owner's equity. Firms finance their assets through debt or liabilities or equity. Everything that the firm has, its assets, minus its debt obligations or liabilities, belongs to the stockholders, or equity. The balance sheet tends to understate the true value of the firm's assets, and in turn the equity. The reason for this understatement comes from a couple of sources. Assets are reported on the balance sheet at historical cost minus accumulated depreciation. This may be different than the market value of the asset. Some assets, such as land, tend to appreciate in value over time. Some assets do not depreciate on an economic basis as fast as they do on an accounting basis. Some assets are more valuable in their cash flow generating capability as they are employed by the firm than when the firm paid for them. Intangible assets are not recorded on the balance sheet unless they are purchased, such as in an acquisition. Intangible assets are things like brand name, copyrights, patents, etc. They have important economic value and they help firms generate cash flows. However, they typically are not purchased and therefore are hard to value from an accounting standpoint. Note, both Pepsi and Coca-Cola have goodwill and other intangible assets on their balance sheets. These are primarily derived from purchases of many smaller companies over their corporate lives and are not capturing the full value of the intangible assets these companies possess. For many companies, their brand name and reputation are among their most valuable assets. Consider Nike. People pay more for their products partially due to the brand name. Coke sells for more than generic cola because people identify with the name brand. Patents and copyrights can be valuable due to the pricing power they provide. However, the value of these will vary significantly based on the specific patent and copyright. Some may be worth millions and others may be virtually worthless. Some activities that are treated as expenses, like marketing, research and development, employee training, etc., can create intangible assets. The balance sheet reflects a point in time. It represents the firm's assets, liabilities, and equity on a specific date. If a firm makes its payroll payment one day before the balance sheet is prepared, the cash account may appear low. If it is ready to make the payroll payment one day after the balance sheet is prepared, the cash account may appear high. Several items on the balance sheet, mainly current assets and current liabilities, will vary significantly throughout the year, so the seasonality factor in balance sheets will be high. Also, if a firm borrows a large sum of money 1 week after the fiscal year starts and pays it back 1 week before the fiscal year ends, this transaction will not have any direct impact on the annual balance sheet. The statement of cash flows is designed to present the firm's income on a cash basis and to show where cash flows come from and went to during the period. The statement of cash flows has three main components: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Cash flow from operating activities measures the firm's operating income on a cash flow basis. It starts with net income and then adjusts to remove accrual-based impacts. For a healthy company, we want to see this be positive and growing over time. If a company cannot earn positive cash flows from its operating activities, it will not be able to stay operational over time. Also, companies strive for growth. If it is not positive and growing over time, we want to see a reasonable explanation and a plan for moving towards a positive and growing cash flow from operating activities. Often, young firms lose money during their first few years. If the firm has negative cash flow from operating activities due to its being young, it is important that we see the values moving toward a positive level. We also want to make sure the firm has enough capital and/or access to additional capital to stay alive until it starts generating positive cash flows from operating activities. Sometimes when there are industry problems or the economy enters recession, many normally healthy companies will see a decline in, or even negative, cash flow from operating activities. If this happens, we want to make sure that it is a short-term issue and is correctable. Cash flows from investing activities look at cash outflows associated with purchasing new property, plant and equipment, or PPE, along with other long-term investments. Also, cash inflows from selling existing PPE and other long-term investments will fall in this category. Cash flows from investing are activities typically negative for almost every company. In order to grow over time, companies need to spend on long-term assets, which causes the cash outflows in this category to outweigh cash inflows in most cases. However, if cash flow from investing activities is growing more negative over time without seeing cash flows from operating activities also increasing at the same rate or better, this is likely a problem. Cash flow from financing activities looks at cash outflows from repaying existing debt, buying back shares of stock, and paying dividends along with cash inflows from issuing new debt or issuing new shares of stock. Cash flow from financing activities often tells us more about where a company is in its life cycle than it does about the company's health. Although negative cash flows from financing activities are preferred to positive values, all else equal. Young firms will typically have positive cash flows from financing activities as they're spending more on long-term investments than they are bringing in from operations. This difference must be financed by borrowing or issuing new equity. Rapidly growing firms will typically have positive cash flows from financing activities as they're spending significant amounts on property, plant, and equipment, and other long-term asset investments to support the growth. Often, not all this growth can be financed from operating cash flows and must come from financing. Older, established firms will typically have negative cash flows from financing activities as they are generating significant cash flows from operating activities and can use the excess pay to pay off the existing debt, buy back existing shares of stock, or pay dividends. Appendix B provides the financial statements for Walmart and Target. In addition, there are listed key financial ratios along with their formulas. See the explanation of the ratios in Appendix B for explanations and interpretations. The ratios covered here are a subset of financial ratios and are not all-inclusive. Financial ratios are tools that allow us to use information from the income statement and balance sheet to look at specific issues associated with a company's financial health. Using Walmart and Target financial statements, ratios for their fiscal years are provided. You are encouraged to calculate at least 1 year of these ratios for practice. The results of the ratio calculations are below. When conducting analysis of Walmart, having the financial ratios for Target is critical for comparative analysis. Ideally, you would use industry averages. However, in this situation, Target makes a nice comparison as they are a similar competitor. 4 years of data were included, so some trend analysis can be done. Both trend and comparative analysis are essential for providing some of the context necessary for financial statement analysis. Note that we say some of the context. It is also important to really understand the specific companies under analysis, their strategies, and the overall economy to get the most out of looking at ratios and common size financial statements. Common size statements are designed to present each line item in the income statement as a percentage of total revenues and each line item in the balance sheet as a percentage of total assets. This makes it easier to compare changes from year to year and from one company to the industry. For instance, below you'll find common size income statements and common size balance sheets for Walmart and Target. Make sure you understand how these statements are generated. When you look at these statements, you can quickly see two important pieces of information. First, Walmart has seen their cost of sales decline over the past couple of years, albeit only slightly, which indicates that Walmart is doing a good job of managing their cost. The second item is that Target's cost of sales is much lower than Walmart's each year. These comparisons are much easier to see on a percentage basis than they would be when just looking at the dollar values in the original financial statements. As a potential investor or management, the next step would be to try to understand what is driving this. Is Walmart doing a better job in negotiating terms with suppliers? Is their ordering and distribution system resulting in more efficient inventory management? Are they able to raise prices slightly? Is Target more efficient than Walmart with respect to inventory costs, or are they able to charge higher prices? Remember that financial statement analysis does not really identify and fix specific problems. Instead, it is the starting point that tells us where there might be a problem. Once we dig deeper, we can then identify if there is a problem and how we might go about trying to address it. Note that there is a concern with cost of sales we'll discuss more in a bit. One issue you'll often find when developing common size statements for comparative analysis is that most companies follow slightly different formats for their income statements and balance sheets. In order to create common size statements for comparative analysis, there are two approaches. One is to obtain financial statements from a source such as finance.yahoo.com, as was done here, which standardize all financial statements into a standard format. Alternatively, you can obtain the financial statements from each firm's annual report and make your own judgments as to how to form them into a standard format. While the first approach is easier if you're doing a formal financial statement analysis, it is essential that you do read through the financial statements in their annual report rather than just pull up the statements from a source like Yahoo Finance. The reason for this is that the annual report will explain all the accounting issues associated with the numbers so that you can better understand the story behind the numbers. Conducting financial statement analysis using ratios and common size statements is as much an art form as it is a science. These tools provide us with a quick way to skim the surface and identify areas that need to be explored in further detail. Contrary to popular opinion, the ratios and common size statements are the starting point for identifying strengths and weaknesses, not the ending points. They help raise red flags over stuff that needs further investigation and identify potential strengths and weaknesses. There are many reasons why something that appears to be a weakness may not really be a problem for the firm, or something that appears to be a strength be more illusion than real competitive advantage. As has been stated previously, it's critical that you understand the story behind the numbers, the context, in order to adequately use them. A quick example of ratio common size analysis for Walmart. Looking at Walmart and doing a quick glance for potential strengths and weaknesses using ratios and common size statements. Potential weaknesses include the selling general administrative cost. Over the 4-year time frame, Walmart has seen their SG&A costs rise from 17.4% of sales to 19% of sales. While this is not a huge movement, keep in mind these higher costs directly impact the final margin. As Walmart's net profit margin was 3% or less each of the last 2 years, it is easy to see that this increase in SG&A expenses is having a noticeable impact on the bottom line. Also, while Walmart had more than a 200 basis point, and note that 100 basis points is 1%, so basically 1 basis point is 0.0001, advantage in SG&A relative to one of their larger rivals, like Target, at the start of the analysis period, that advantage has declined to a mere 20 basis point advantage. This is another indication that SG&A costs are a concern for Walmart. The key to figure out why these costs are rising. It's a sign of inefficiency, or is Walmart intentionally increasing spending in this area to gain other advantages? Accounts payable. We want to be careful calling this a weakness, as having higher accounts payable could be a sign that we're struggling to repay our inventory purchases, or it could be a strategy to improve our cash flow by hanging on to our cash a little longer. However, the fact remains that the accounts payable as a percent of assets has been increasing over the last few years. It would be worthwhile for analysts to get a good understanding of why. As mentioned earlier, Walmart has seen its SG&A expenses rise as a percentage of sales. This in turn has had a negative impact on their profitability ratios. The net profit margin, which we can see as both a ratio or in the common size statements, has declined over the 4-year window. Their ROA and ROE have also declined over this time period. While we know the key reason for the decline in profitability are the higher SG&A expenses, it is not clear what the fix is for the issue. That said, awareness of the issue can be useful to management or investors. Walmart has seen their net income decline each of the last 3 years. While the decline has not been extreme, it has been noticeable and is off by nearly 20% from its peak. This is something that should draw the attention of both management and current or potential stockholders. Now turning to potential strengths. DSO. If we look at Walmart's DSO ratio, we can see a couple of things. First, the ratio itself is quite low as it takes them less than 5 days on average to collect their credit sales. It also has declined over the past few years. If you do comparative analysis, you may notice that Target's DSO ratio is amazingly zero. They accomplished this by selling their receivables. Therefore, their corporate strategy to sell their receivables is driving the result rather than their specific credit terms. Inventory turnover. Walmart has seen their inventory turnover ratio increase slowly over each of the past 4 years. Importantly, it is also significantly higher than one of their primary competitors, Target. This indicates that Walmart does a good job of moving through their inventory and not building up excess inventory. Maintaining a high inventory turnover ratio helps avoid spoilage costs and frees up financing costs as the firm has less time with dead money invested in inventory that is either sitting on store shelves or in the warehouse. Fixed and total asset turnover. While there's a slight uptrend in the asset turnover ratios, the real advantage is seen in comparison to Target. Walmart does a much better job of generating sales from its investment into assets. One thing that should be noted is that some of this could be tied to strategy. Walmart has a notably higher cost of sales than Target. One explanation for this is that Walmart is pursuing a lower margin, higher turnover strategy, while Target is pursuing a higher margin, lower turnover strategy. This is not an argument that one strategy is better than another, but instead is a way for the two firms to create a little differentiation in their markets. Cash flow from operating activities. While Walmart's net income has declined noticeably over the past 2 years, their cash flow from operating activities has increased rather significantly over the past 3 years. Given some of our issues with net income, this may be more relevant. On the other hand, it may be a little misleading. For example, over the past year, Walmart has seen their inventory drop by a little over $1 billion and their liabilities increase by about $5.5 billion. Are those sustainable changes? Most likely not. This may lessen the importance of the increase in cash flow from operating activities over the past year. Without those changes, we could be looking at a net decline over the past 2 years. Other notes include, from the cash flow from financing activities portion of the statement of cash flows, we can see that both firms have been active in buying back shares of their own stock over the past few years. This is neither a strength nor weakness, but a way to return cash to shareholders, in that these firms use buybacks as a partial substitute to paying higher cash dividends. Similarly, both companies have been engaged in retiring their long-term debt over the past few years. The fact that cash flow from operating activities has been significantly higher than the outlays these firms have allocated to cash flow from investing activities, they have had significant ability to pay dividends, buy back shares of stock, and pay back portions of their long-term debt. When dealing with quarterly financial statements, we must be aware that many firms face seasonal patterns that can cause the numbers to behave strangely. Be careful to compare quarter one of this year with quarter one of last year instead of the previous quarter when you have significant seasonality. Quarterly income statements, quarterly balance sheets, and annual balance sheets all have seasonality. Calculating ratios using inputs from any of these statements, we must be aware of seasonality. While firms in the same industry will often have similar seasonal patterns, it is important to watch the fiscal year. A fiscal year is different from the calendar year, and some firms end their fiscal year at the end of December, while others end their fiscal year at the end of January or March. If firms have different fiscal years, their ratios and common size statements may not be comparable. While all firms use generally accepted accounting principles, there's a lot of flexibility in applying GAAP. Different depreciation approaches, inventory methods, etc., can cause two firms with similar levels of business activity to appear to have different levels of profitability. The better you understand financial accounting, the better you'll be able to dig into a company's financial statements and understand exactly how comparable the ratios are across firms. While Walmart and Target have a lot of overlap in their primary business activities, they also have some differences. Be careful when comparing firms that the difference in the ratio or common size statement is not caused by non-comparable differences. This is where a thorough understanding of the company comes in. We previously discussed how the differences in cost of sales and turnover ratios could be related as much to strategy differences as they are to differences in the underlying performance. The best way to find out about this is to read each company's annual quarterly reports, the 10-K and 10-Q, listen to conference calls made during quarterly earnings announcements, and pay attention to all aspects of the companies. Good financial statement analysis involves a lot of digging and attention to detail, not just number crunching. When dealing with large dominant firms, it is difficult to compare them to industries because they may dominate the industry and/or operate in many different industries. This is why it may be better to compare Walmart to Target rather than industry averages. If I compare Walmart to the industry average, those numbers are going to be heavily influenced by Walmart's numbers, as Walmart makes up a large portion of the industry. Consider the low current ratios for Walmart and Target as well. They appear to be struggling to meet their liquidity demands when looking at the current ratio. However, one of the reasons for a low current ratio is that they have high inventory turnovers and they know that they will quickly be able to generate the cash necessary to pay off their current liabilities. Another issue is that they are a very profitable company with predictable cash flows, so they don't need much of a cash cushion to keep them safe from downturns. This allows them to move more cash into long-term assets which earn a higher return or to return that cash to investors through dividends and stock buybacks. What appears to be a liquidity problem is likely more of a strategic decision to keep current assets low and invest more capital into long-term assets which can be more productive. Finance focuses on future expectations and financial statements describe past performance. This does not mean that financial statement analysis is meaningless. It is hard to understand where you're going if you don't know where you've been. Financial statement analysis can help us see potential problems as they are developing so we can correct them, if we are management, or avoid them, if we are investors. However, we must be aware that things can change quickly in the business world. What was a strength 6 months ago when the financial statements were prepared may very well be a weakness today. Always be digging for new, updated information to avoid being blindsided by major, unexpected changes when new financial statements are released. Companies change management and corporate strategies. New competitors enter the industry or existing competitors leave the industry. Technology and legal aspects change. Economic conditions change. All of these things can make it hard to use past financial statements to make forecasts about the future. Again, it doesn't mean that we ignore financial statement analysis. Instead, it means we must be aware of the limitations and recognize that the numbers are a part of the story and not the story itself. Any financial ratio without the proper context is close to meaningless. Think of the following analogy. Imagine you go into a doctor for a health checkup. One important piece of information for the doctor is your weight. However, if the doctor were to see a chart of patient X and find out that the patient is 150 pounds, that information by itself is not very valuable. Is the patient a 6'6", 30-year-old male or a 4'2", 12-year-old female? Did the patient weigh 135 pounds, 150 pounds, or 200 pounds 6 months ago? All the vital information the doctor collects, temperature, allergies, symptoms, blood pressure, etc., are used to help diagnose the health of the patient together. Any one of these pieces of information without context is not very useful by itself. Financial ratios are very similar. Ratios and common size statements are initial diagnostic tools. Similar to the item above regarding context, a medical analogy is helpful. When you go into a doctor with a set of symptoms, the doctor gathers information on you and your symptoms to get an idea of what might be wrong. Then, unless it is something common, the initial diagnosis is used as the basis for further testing and examination to find out what is really wrong. Ratios and common size statements are similar. They can be used to raise red flags, but we want to be careful to remember that they identify areas that need further investigation more than they clearly identify strengths and weaknesses. There are the sources cited from Business Finance Essentials. Thanks for watching. Be sure and like, subscribe, more content like this.